Welcome to the Return on Lifestyle podcast with Rey Descalso from Pravada Wealth Management. In this podcast, we help you overcome financial worries and make sense of planning, investing, insurance, and banking. Join us for this journey as Rey draws from his expertise and interviews brilliant minds to help you enjoy life. The best is yet to come.
Hi, thank you so much for tuning in. My name is Rey Descalso, and today I want to talk to you about the idea of a Roth ransom. Haha, what does that mean? Well, you've probably heard of Roth conversions, and I think that's great. Roth conversions are fantastic, but I like to call them Roth ransoms. And the reason is I think you need to understand that just like a ransom, if someone were kidnapped, if you were to ransom them, it's going to cost you something. And the question you got to ask yourself is paying that ransom worth it? All right, so let's back up. What is a Roth conversion? Now I've got some blog where we've written about Roth conversions, and you can also Google Roth conversions. But basically, the way it works is like this. Imagine you have a traditional IRA, and this doesn't just apply to traditional IRAs. It applies to 401ks, 457s, tax qualified plans where you do not pay taxes on what you put in, but you pay taxes after years of deferred growth. You take the money out and you will pay ordinary income tax on what comes out of your traditional IRA, your traditional 401k, your traditional 403b, that type of a setup, okay? So going forward, though, I'll just talk about traditional IRAs. And if you've got questions, please give us a ring, give us a call. We'd love to help you out and explain how it works and how these principles apply in your situation. Now, having said that, how does a Roth conversion work? Well, you've got your money in your traditional IRA. And many of you watching this, you never really had an opportunity to put money into a Roth IRA. Either you made too much money, and so you were never going to be able to do a Roth IRA, or no one ever told you about a Roth IRA and why it should be a part of your financial plan, or you only had a traditional 401k at work all these years. You never had a Roth 401k feature. They're relatively new, actually, and not many business owners out there know about the Roth 401k option that should be available to you there at work. Well, either case, you've got a traditional IRA, and let's just say you've built it up, you've got $1 million in your traditional IRA. Now, you haven't paid taxes on any of that money. And so when that money comes out, you're going to pay ordinary income tax on whatever you take out. And the idea is when you were making $100,000 a year, it was nice to be able to put away $2,000, $3,000, $4,000, $5,000 into this traditional IRA so that you could not have to pay taxes on that $2,000, $3,000, $4,000, $5,000. And the reason I keep saying the different amount is because that amount has gone up every year and will continue to do so, let's hope. So you haven't paid taxes, and now you're about to retire, and then all of a sudden you're realizing, wait a minute, I'm going to have to pay taxes on this money when it comes out. But that's okay, because I'm not making $100,000 anymore. All I'm making is what I'm making off Social Security, and I don't have a pension, and all my debts are paid off. I don't need much money. I've got some rental properties. I've got some other sources of income coming in, and I live a pretty simple lifestyle. So really, all I need is my Social Security and maybe a little bit of money from my traditional IRA from time to time. Okay, well, that's interesting if that's your case. And everybody's situation is different. So why would you want to take money out of your traditional IRA and put it into a Roth IRA? Well, here's the rationale. A couple different things. Number one, you have to look into the future. And as you look into the future, you have to ask yourself, given the Trump tax code, the tax code that we have right now, and I'm giving this video out 2019, so we really have a good handle on how the Trump tax code works. Do you think when this tax code sunsets in 2026, do you think taxes are going to go up, or do you think taxes are going to go down for you in your situation? Well, that will determine on whether or not a Roth IRA makes sense to you. You see, the reality is we don't know if taxes will go up or if they will go down. We just do not know the answer to that question. I can show you how Reagan lowered taxes from what Carter had, right? But I can also show you how Clinton lowered taxes from where George Bush Sr. had them, right? So everybody who comes into a presidency doesn't always lower taxes. Sometimes they raise taxes. We don't know how it's going to go. What we do know is that right here and right now, The Trump tax code has done very well, especially if you are less than $80,000, married, filing jointly, and 65 years old. If that's you, then you really have some great benefits. And in my Taxes in Retirement workshop, if you want to come out to that, I share exactly how it works. But suffice it to say, if you're getting close to retirement, now may be a good time for you to consider Roth conversions. Why? Because you are in a favorable tax situation. Because $80,000, 65, not really needing much income, you probably are less than $80,000, especially when you understand how Social Security is taxed. You see, Social Security, and you can say whatever you like about the fact that it is taxed. I would love for it to be tax-free income, considering that you worked hard, put money into the system, and now that you got to pay taxes again on the money that was created because you were taxed. I don't know. I don't make the laws, folks. I'm just letting you know strategies on how to best or how to potentially maximize your after-tax income. So you're 65 or so, and you say to yourself, I may want to convert some of my traditional IRA into a Roth IRA. Number one reason would be because the Trump tax code as it stands right now, especially if you're 65 and older, and even if you're not, I know I paid less taxes in 2018 than I had in the years prior, and I made more money simply because of the way the tax system was set up, because of the exemptions. We can go more into that one-on-one. I don't want to go too far. So if the tax code is good for you right now, it means you're going to possibly pay less taxes on the money you convert. See, when the money goes from a traditional IRA into a Roth IRA, imagine it's like you've got your traditional IRA money in this pocket, right? And you want to put it into your Roth IRA. You can do it. You can put $1 from this pocket, put it into this pocket. But then when the tax man comes next year, on April 15, you've got to pay taxes on that $1. And those taxes are paid from a completely different pocket, from the money in your bank. You cannot withhold from the money you're converting. It has to be paid from your bank account. Now, the second question for you then would be, well, if I got to pay taxes now, why would I want to pay taxes now? Well, it's a question I alluded to. In 2026, when the Trump tax code sunsets, will the Trump tax code, or whoever's president, I guess it may not be Trump, but whoever's president, will they have a lower tax bracket for you or a higher tax bracket for you relative to where you are now? And the reality of it is we don't know. But what we do know is that as I'm recording this, we have $23 trillion in debt. Now, our debt, as I'm talking to you right now, is 106% of our economy. It was higher in 1946 after World War II. And I don't think it's been this high since 1946, when it was like 114% of GDP. The point of my story is we have record high debt, record high demographic situation where we've got lots of retirees turning 65. When they turn 65, they get Medicare. Many of them already have, and some still will turn on Social Security. So the unfunded liabilities are pretty onerous. And the way we pay our bills is by taxing the citizenry. And we have to think to ourselves, do we prepare for the best case scenario, or do we prepare for the worst case scenario? Well, if you'd like to diversify, if you'd like to hedge your bets, then you would do a Roth conversion and pay some taxes now, so that if you're right, then the money that's in your Roth IRA, you'll never pay taxes again, right? If you're wrong, well, Ray, we shouldn't have done that, but we did our best to prepare for the worst, not prepare for the best, okay? Prepare for the worst, hope for the best. That's what you got to do, right? That's common sense. So let's just say you've decided, based upon what I've shared with you, that yes, I do want to convert my Roth, but how much do I convert? That's where it gets interesting. Right now, as we come to the end of 2019, you really need to meet with your CPA and do some forecasting. We need to take a look at your income, and we need to figure out what tax bracket you're going to fall into. Because let's just say you fall into the 12% tax bracket. Let's just say that you, married, filing jointly, 65 years old, you're going to be in the 12% tax bracket. Do you know what the next tax bracket is? The next tax bracket, according to the Trump tax code, is 22%. So 12, 22. And it changes. Married filing jointly is different than singles different. But talking about married filing jointly, if we know you're in the 12, then we've got a nice little spot before you get to 22 where we can convert some money. But if we convert too much, we'll jump you up into the 22% bracket. And if you convert that $10,000 and you're in the 22% bracket, you're paying $2,200 on that $10,000 conversion. Wouldn't it make more sense to try to convert and keep you down lower? And it would. And so we want to take a look at your exact numbers and then decide how much you convert. And then also too, you've got to ask yourself, well, how much money do I have in the bank? Because when I go from my traditional IRA into my Roth IRA, I'm going to have to pay taxes, and the taxes don't come from your traditional, they don't come from your Roth, they've got to come from your bank account, they've got to come from somewhere else. And so you have to ask yourself, if I'm going to ransom money from my traditional IRA into my Roth IRA, is that ransom worth it? Number one, do I have the money to pay the ransom? Number two, is the ransom too high? Can I keep the ransom as low as possible? And then number three, how much do I ransom? Because you can ransom $1 or you can ransom $10,000, and each number is going to have a different impact on your particular situation. Here's the good news. The good news is we have a software program called a tax map, and the tax map will help us to guesstimate how much it's going to cost you to convert $1, $10, $20, $30,000. We'll chunk together. We'll take chunks of your Roth and run it through our program and get a good idea, and then we'll run those numbers by your CPA, because there's nothing more that I love than working with people's CPAs to really dial it in. And in the future, down the road, you'll never pay taxes again on that Roth IRA or the growth of that money. And so that's one of the reasons why we want to consider ransoming your traditional IRA, ransoming those dollars, and converting to a Roth. Now, if you haven't had this conversation already, give me a call and let's talk about it. And let's see how your particular situation works out. Rey Descalso for Privada Wealth Management. Thanks so much for tuning in.
Thank you for listening to the Return on Lifestyle podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Privada Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider for any questions you may have regarding your investment planning. The following program is sponsored by Privada Wealth Management, which is solely responsible for its content. Advisory services offered through J.W. Cole Advisors Incorporated. Securities offered through J.W. Cole Financial Incorporated. Member IFNRA, SIPC. Privada Wealth Management is an unaffiliated entity from J.W. Cole Advisors and J.W. Cole Financial. The opinions expressed by Rey Descalso should not be construed as specific investment, legal, or tax advice. All economic and performance information is historical and not indicative of future results. Investing may involve the risk of loss of principal. Any tax advice on this show is not intended to be used by any person for the purpose of avoiding U.S. federal or state tax penalties that may be imposed on such person, and each listener should seek advice from their tax advisor or legal counsel on topics that arise from the show. Nothing should be construed as solicitation of an offer to buy securities. The preceding program is sponsored by Privada Wealth Management, which is solely responsible for its content.